Hi everyone, it's your regular finance and HR consultant. If you're here for the first time, please click the subscribe button. And if you've been here before, thanks for coming back. And I'm going to be talking today to you about the differences between bonds and stocks. So, what are the main differences between bonds and stocks? Because all of them to an extent can be called marketable securities. Bonds to an extent can be marketed, but not as much as stocks. So, what are bonds? Bonds are an amount of money that you pay to a company or to an establishment, to a government agency, that you'll be rewarded within a specific period of time, 0 to 30 years. So bonds could have coupon or they could be zero coupon bonds, which means, let's take for instance, you pay $10,000 into the coffers of the United States of America that are going to give you back $30,000 in 30 years. Within the time period, you receive zero interest, that is zero coupon. And in another scenario, you give in 10,000, you buy bonds worth $10,000, and you're going to be given 6% per annum. 6% of 10,000 is going to be 1,000. So you'll be receiving 1,000 per annum. And at the end of the duration of 30 years, you are still going to receive your $10,000, which you paid into the coffers. On the contrary, stocks are a promise. Stocks, on the contrary, are ownership. So that is equity finance. Meanwhile, bonds are debt financing. It's a form of debt finances. And stocks are a form of equity finance. What does that mean? It means that if you pay an amount of money into a company in exchange for stocks, it means you own a share into that company. You are one of the owners of that company. And if the company is worth $30,000, you pay in $1,000 into the company in exchange for stocks. It means your ownership of the company is to the tune of 1,000 over 30,000. So that is your ownership over that company. Now, which one is riskier between bonds and stocks? Of course, bonds are less risky, because in case of the company not doing well, if they have to go into bankruptcy, they have to engage in paying bondholders. But stockholders will have to wait until all bondholders are paid. If there is something at the end, they will get it. Now, which one is more profitable or likely more profitable? Stocks are more profitable, because if the company gets into a lot of profitability, they won't change the percentage that they have promised bondholders. They will still pay you the same percentage, but right now they're more profitable. So at the end of the day, shareholders are going to be having more money than you, the bondholder. So you, as a young investor, which one are you going to be going in for? Are you going to go in for stock, or you are going in for bond as a source of financing for your company? Are you going to release? Are you going to be ready to give out shares to stockholders, or you are ready to collect money from them in exchange for bonds, so that you'll be able to refund their cash at the end of the day and you own all your company alone? Which one are you going to choose? And you, as an investor, which one is preferable for you? I want to know in the comment section. And if there's a part of this that I've not covered, please feel free to comment about it, and I'm definitely going to cover it. In my next lesson, I'm going to be taking this to another level. So please do not miss. If you have not subscribed yet, please subscribe and drop a comment. Don't forget as well to click the notification button, because I'm going to be here for you to enlighten you so you can take your financial decisions to the best of your ability. Bye.